Here's another TCon video, and this one's designed to help you with T accounts and banking problems involving the deposit expansion or money multiplier. So we'll see how we can use balance sheets, thinking about assets and liabilities to help figure out problems like that, make them a little bit easier. So the first place I want to start is on a handout that's titled The Multiple Expansion of Checkable Deposits. And I think you worked on this one a little bit a few days ago in class. I want to zoom in and just make sure that we're solid on a couple of things that would have been discussed in class but are kind of challenging to figure out on your own. So down here by these balance sheets idea or T accounts, I want to talk through a couple of items that make sure we grasp that these are assets and liabilities on the balance sheet. So what's an asset? That's something that has a monetary value that you could sell. And what's a liability? It's a debt that you owe that you can put a monetary value on as well. What are banks' assets? First and most important, whenever you see a balance sheet, is one of the things you're going to see under assets is reserves. That's money the bank holds, and part of it at least, maybe all of it, they're holding in satisfaction of this requirement by the Federal Reserve that says you have to hold on to a certain percent of the demand deposits or checkable deposits that customers put into your bank. And that's a important protection so that if we go into the bank and want to withdraw money that's in our checking account, the bank has a certain percentage of that. They can hold that money either as vault cash or in a reserve account at the Fed. So if you see separate entries for how much is in the reserve account and how much is in vault cash, usually it's best to lump those together and then do the analytical process of figuring out how many of those are excess and how many are required. The excess reserves are almost always the key to figuring out any T account problem. There's other types of assets that the bank has. The bank might hold bonds, and that is basically a ticket that the Treasury owes you money sometime down the road when that bond matures. So that bond is an asset to whoever holds the bond, the same way if you had a savings bond, it would be an asset to you as well. Loans that the bank has made to customers mean those customers owe that bank back money. Most of those loans would probably take the form of home loans, mortgages, where somebody owes that bank money for a period of 20 or 30 years, a little bit every month, or a car loan where somebody owes that bank money every month for, say, maybe about 5 years. If the bank has loaned money to other banks, those banks owe that first bank money, and so those are assets to that first bank. And then, of course, they otherwise have assets that usually we don't think about in these problems. Sometimes they might not have been listed on some of the sample T account problems asset column, but of course they have physical assets such as real estate. That's the building that the bank is built on, and the desks and computers and chairs that are inside of the bank, that type of thing. On the liability side of the ledger, the biggest and most important one to think about most of the time is demand deposits or checkable deposits. That is money that you or I might have put into our checking account at that bank. And the bank, from their point of view, that money is a liability because we could walk into the bank and ask to withdraw it. So we are owed by the bank owes us that money. Any other money that they had borrowed, and you think about where can banks borrow money? Well, they can borrow money from the Federal Reserve, and they do that at the Fed's discount window and then pay the discount rate. Or they could borrow money from the other banks. And the way that banks loan money to one another is through this institution known as the federal funds market. It's a loose affiliation of maybe a dozen or more federal funds dealers. And essentially, the price of money in that market is called the federal funds rate. So the federal funds rate is the rate that banks lend to one another. Discount rate is the rate the Fed will lend to a bank. Those are key vocab terms to learn if you haven't already picked them up. And then there's other asset or liabilities that the bank may have, like if you put money in a savings account, often that won't be listed on sample T account problems that we have to do because they don't want to confuse you. The reserve requirement, how much they have to hold on to, only is a percentage of demand deposits. And then we put stock outstanding or owner's equity down there, not because it's really a liability, but it helps us, if we see that picture, then all the things over here in red will necessarily add up to the same value as all the things over there in green. And that's an awesome thing to think about when you're working with T accounts. In fact, the first principle I like to say is that the balance sheet balance, so total of all assets equals total of all liabilities, and that'll be true both before and after any transaction that you might have to think about happening or affecting a bank's balance sheet. The second rule of T accounts is that banks have to keep a certain amount of these demand deposits on reserve, and that's the required reserves, and that's the Fed sets a percent. Oftentimes we might use 10% as an example. That's pretty close to the real level the Fed requires. So of all the dollars that people put in checking accounts at your bank, you have to hold on to 10% of that much, and you can only loan out the other 90. A third rule or principle of T accounts is that these excess reserves are the place where banks can create new money, and they do that by lending excess reserves. And so that's how many the bank can lend, so many that bank can create. And if we take that times the money multiplier, the reciprocal of the reserve ratio, if we take excess reserves times that money multiplier, that's how many the whole banking system can create. We'll see some examples of that sort of thing happening. On the next page, you had some space to think about what the main assets and liabilities for the Fed are on its balance sheet. And I'll just let you know that the bank one we just did was an oversimplification, and this is a really gross oversimplification. But in the interests of keeping things a little bit simple, I'll talk you through sort of what the textbooks would say. And if you want to go to the Fed's website, they actually publish their balance sheet every 2 weeks, and so you can see in all gory detail and try to figure out what all the things mean. And I've looked at it a couple of times, but I haven't figured everything out, and I don't want to. At any rate, the Fed has bonds. Those are, again, a liability to the Treasury Department and an asset to the Fed. The Fed holds those and earns interest on them, and in fact, that's their main source of operating revenue, and they use what they want and forgive the rest of the interest back to the Treasury. The Fed also holds precious metals like gold and some foreign currency. That, of course, would be an asset to the Fed and a liability against whatever central bank issued it. Like if it was pounds, it would be the Bank of England. And then, of course, if they've lent money to banks, those banks owe back that money to the Fed's discount window, and so those would be assets to the Fed. The biggest and most important liability on the right side of the ledger for the Fed is Federal Reserve notes, and those are the green bills, pieces of paper, $20 bills, $10 bills, $5 bills that we hold in our wallets and purses, and that are sitting in ATM machines. Well, not the ones sitting in ATM machines ready to be withdrawn, because those are not actually yet in circulation. Once we withdraw them, then they become a liability to the Fed. And then anytime a bank has put money into its reserve account, that's money that the bank put in its account at the Fed, and the Fed owes back to that bank, so that's a liability against the Fed. Presuming you grasp a lot of that, then we're ready to skip ahead a little bit. The rest of that handout was worked on in class, but I want to sort of explain to you how you might work through this one here called the mechanics of monetary policy. And one huge thing that you just have to be able to think about in order to make the math work on this one is that you are always starting with this page here that says 38.1, a baseline T account. And the first thing that I would do, even though there's no blanks to fill in, this page with the baseline account is on the page that the handout calls 199. I would look at that and look at the one that's immediately to the right and really study how did it change when the Fed's action was to buy $10 worth of Treasury securities or to buy U.S. government bonds in the amount of $10. And then you can look at all the bolded values here and see exactly how much did they increase or decrease by. And you'll notice that at the end, they ended up juicing up the money supply. This was expansionary monetary policy, and they wanted to increase the money supply by $100. It was $353 before, and now it's $453. And you think about what's the components of M1, the money supply that we're thinking of here. Well, it's going to be these 53 Federal Reserve notes, that's cash the public holds. And then it's going to be these $400 of money that the public holds in their checking accounts. So that's what equals the 453. So after you go through and kind of compare all the places where those changed, then the puzzle that they give you is a different prompt. They say start with that baseline case again. And I can't really emphasize that part enough. Let me put that up here and really like circle that in orange, because you got to go back to that baseline case there and see what values were originally on the T account and then figure out how they change. So first we have a couple of thinking questions to do, and what I found it useful to do was to sort of set that picture of the baseline case right next to the picture of the blank T account that I'm trying to fill out down here, and then I can think about how each value changed. If you have the ability to separate the thing in half and do that, that might be the easiest way of doing it. Let's go ahead and think through some of these preliminary questions here before we get to the T account. So what they've told us is that the Fed wants to decrease the money supply by $50. So in order to decrease the money supply, we want to have contractionary policy. And hopefully we know that selling bonds is contractionary policy. So the Fed needs to sell securities or bonds. And that's a tool that they use to drain the banking system of reserves, to decrease the amount of money that's out there in the money supply, therefore pushing up interest rates, discouraging people from spending, and ultimately shifting AD to the left. That's contractionary monetary policy. Well, let's think about the next thing they ask us is what is the money multiplier? And I'm going to have to come up here to this 10% value. The money multiplier is always the reciprocal of the reserve requirement. So I guess we might be thinking about an equation sort of like this, 1 over 0.1, where the 0.1 is coming from that 10%. And that'll give us a money multiplier value of 10. What is the value of treasuries that need to be bought or sold? Well, we know it's sold, and we know that whatever we do is going to be magnified by a factor of 10. So 10 times the bonds we sell equals $50 of decrease. Sounds to me like we need to, oh goodness, we need to use the eraser here a little bit. That's over there. Gracious. Get rid of that and go back to get a pen. And now we'll say that they need to sell $5 worth of securities. Now, would the Fed ever sell $5 worth of securities? No, maybe these numbers are in millions or billions or something like that. But they're trying to make the math easy for you. And adding or subtracting units of 5 is probably going to be pretty handy here. Okay, so now we move down to this situation here, and we'll zoom out just a little bit so that we can see a tiny bit more of it, maybe. Well, that's a bit smaller. I'm going to have to write neatly. Okay, this is all right, though. We can kind of keep what we thought about above in place. And I'm hoping that you're able to see the baseline case along with this one and watch it change. If you're totally clued out and have no idea, just look at the baseline case and watch how I'm making a change here. We decided above that the Fed was going to sell 5 securities. So however many they had, they're selling 5. And if you look at the previous value there, that was 83, I think. And so that will leave the Fed with $78 worth of securities. Okay. Now let's think. The Fed's balance sheet has to balance, right? And the Fed just sold $5 worth of bonds, and who will pay them for it? Well, one way that they could do that, in the same way that maybe if you asked your bank for them to perform some kind of a service, maybe giving you a box of checks, or perhaps replacing something for you, and then there was a charge associated with that. Well, I guess you could pay them, but also they could subtract that money out of your checking account. And really, that's how the Fed works here. They're going to say, hey, bank, we're going to take $5 out of your reserves. And before we had 26 in here. So if we had 26 and we took away the 5, that's where we would get to a number like 21 right there. And then we could double check, because this is a little bit like Sudoku, right? The assets and liabilities have to equal each other at each of these levels here. So 78 equal 21 plus 57, check. Yes, it does. Okay. Now that $21 is more $21 that the Fed is holding on to for banks in their reserve accounts. Well, that's the same money here that the banks have put into the reserve accounts. So that's also 21 for the same reason, is that's banks used to have $26 in their reserve accounts, and then they bought things with it for their customers, actually, in this case, and those things cost 5. Okay. The Federal Reserve notes, one thing that's kind of interesting about this puzzle is that those 57 notes never changed when the Fed did expansionary or when it did contractionary policy. So that's still 4 and 53, and that's where those 57 notes are. The Fed pushed out $57 bills, and banks have 4 of them, and we have 53 of them. All right, so what to do after this? This is where you might feel like maybe you could imagine yourself at a little bit of an impasse. We can work up from the bottom a little bit, maybe, and say that the public used to have 52 securities. And what are they doing now? They're buying 5 more. Remember, the Fed sold them, right? So they're buying 5 more, so that's 57. All right. What else? Um, well, let's think about these two numbers here, 21 plus 4. 21 plus 4 is 25. And that really is $25 worth of reserves that the bank held. How many checkable deposits could that support? Well, this number has to be 10% of the amount of checkable deposits. And that number used to be 300. And then we're going to actually subtract 50 from it. That's 250. All right, now by elimination here, I think we can sort of isolate that loans. What would that $250 that was put into the bank plus all 135 here? Well, they kept 25 on reserve because they had to, and they lent out the rest. They lent out the 135 plus the 225. And so that's a total of 360. And what you can see here is this value used to be, I think, 405. And what did we do? We subtracted 45 from each side. And you notice here, total liabilities went down by 50 and total assets went down by 50. Total assets went down by 5. Total liabilities went down by 5. It leaves the thing entirely balanced. Now we're just filling in these for sort of a double accounting purposes. This $250 that banks are holding on to for their customers, it's the same $250 that customers have put into the bank. And the 360 that's been loaned out, well, that's the same 360 that the customers owe to the bank, and therefore it's a liability to them. And now let's double check. We wanted that money supply to be $303. Let's go ahead and see what is the money supply. Well, the public holding 53 Federal Reserve notes right there, we'll do it in green, that 53, and this 250 right here. Those are the 303 that we wanted. And then our answer checks out very nicely there. Let's think about a couple more of the answers to this sheet that can kind of challenge you. And I will tell you that if you can do this, you're fairly well prepared to work through T-account problems that you may run into. They ask us to find the deposit expansion multiplier from a 15% reserve ratio, and that's probably nastier than you might have to do in a lot of situations. It's 1 over 0.15. And I think that gives us a value of 6 2/3. And I don't think I'll ever make you do a lot of work with a money multiplier that has a fraction in it, especially thirds aren't that friendly. But anyway, we could do that. If you deposited $100,000 into a checking account, the bank has to hold on to 15% of that, or 15,000, and then therefore they can lend the other 85,000, right? So some of this is sort of just basic math here. What two forms can they hold the reserves? You can see earlier in the video we could talk about that as being either vault cash or putting it in their reserve accounts. What if the $100,000 in customers' mattresses how much will the deposit cause the money supply to grow? And this is a situation where we would take that 100,000, multiply it by the money multiplier, and then say, but hey, that 100 was already part of the money supply. And so really what I think you're going to see is that the 100,000 becomes $666,666, and really the increase is $566,666. Low interest rates encourage borrowing, and the reason why is because it's cheaper to pay back the funds you borrow. This is a bad question because the Fed has changed its policy since then. Now it keeps the discount rate a little bit above the federal funds rate because the Fed views itself as a lender of last resort. There are Oops, I think I missed something back there. Sorry about that. Let's scroll down a little bit and think about these last couple. This is kind of an interesting situation. It's 1/1, so their money multiplier would be just 1. This is a country that has no fractional reserve banking at all. The banks can't create money in that country. The last thing here, what would the Fed want to do if they want to increase the money supply? They are going to increase reserves in the banking system. This is very difficult to draw in a way that makes me feel good. And then that will cause the federal funds rate to decrease. And the big idea is they're increasing the money supply in order to push down interest rates, including the federal funds rate, which causes more investment and more interest-sensitive consumption. Here, you want to think about expansionary or contractionary policy according to whether it increases or decreases these two columns. And this works well in conjunction with the little grid underneath. The expansionary tools are right there, and right there, and right there. And all three of those are things that are going to increase reserves or excess reserves. They're going to increase the money supply, and they're going to push down the federal funds rate in order to encourage more lending and spending and more AD. The other three things we could identify and flag in red perhaps, and those are our tools of contractionary policy. These three here are designed to increase interest rates, like this one here, and they do so by pushing down the money supply, and that's an effect of draining reserves out of the banking system. So buy bonds to make the money supply bigger, sell bonds to make it smaller, raise things in order to raise the interest rate, lower things in order to lower the interest rate. And hopefully that can help you with that part of it. Here's another garbage question because the Fed has changed its policies. What else do we know? They rarely use the reserve requirement because it's a little bit too strong of a tool. And I think they worry that if they reduce the reserve requirement, we might show up at the bank, ask for our money, and banks might not have enough to give it to us. So they like to track over time what the very maximum amount of all of our cash that we try to withdraw from the bank is, and make sure that banks hold at least that much, because public confidence in the banking system is really important. And if you've seen any movie or play, Mary Poppins might come to mind, where there's a run on the banks, where people go to the banks and try to withdraw all their money, and the bank says, hey, we don't have enough. That can be very damaging to public confidence in the banking system. If the people don't use banks, then the Fed doesn't really have a tool that controls monetary policy. We could talk about the discount rate and the target for the federal funds rate as both being things that the Fed does that are when they make announcements of their target federal funds rate or when they change the discount rate, they are communicating to lenders and borrowers, this is the rate we're going to make be the dominant interest rate in the economy. And it's important to remember that the Fed has an endless supply, basically, of bonds to sell, or an endless supply of money to create to buy new bonds if it wants to force the issue and make that the interest rate. So banks really understand and recognize that they can't really fight the Fed on that. That's the Fed sort of saying, hey, this is now a point of emphasis. This is what we're going to try to do. Why do they target the federal funds rate rather than the money supply? To answer that, you really have to think about the money market graph, which I'm going to do in a separate video, but I'd like for you to consider that if money demand and money supply are constantly shifting around for reasons that are sometimes predictable but sometimes not, it makes it hard to track both of those and the slope of the money demand curve in order to figure out where the money supply line the Fed can control, where they should place that in order to have interest rates be at the right place. They've found that an easier approach is to track the effective federal funds rate and compare it to the target. And that target is a quarter-point range that they've announced. I believe at the time of filming this, it's between 2 and 2.25. And the idea is that if it starts to create, the effective rate is the rate banks are actually lending to each other. And if they start lending to each other at a rate that's a little higher than the Fed's zone, well, the Fed will increase the money supply and push that rate back down. And if they start lending to each other at a rate that's a little bit lower than the Fed's comfort zone, then the Fed will sell some bonds and shrink the money supply and try to push those interest rates up just a little bit. Last thing I want to do for you here is to take a look at a past short AP exam question and think through how we might do that based on our knowledge of the principles of T accounts. So they presented us with a simplified T account here, and you can notice that they just have 3 items over here and 2 over there. But first take a look. The total on the left equals the total on the right. And then they ask us some questions about it. And sometimes they ask us, how will such a transaction change a certain value? And that can be a bit of a tricky thing. What is the reserve requirements? The first thing they ask us. Well, we know, I hope, that we can take required reserves divided by demand deposits, and that will get us the reserve requirement. So what would that be there? That's 10,000 over 100,000, which leads us to 10%. So I'm just going to write 10% because they told us to calculate that. All right, now B. How much? Assume Luis withdraws $5,000 in cash from his checking account at MeTerra Bank. By how much will MeTerra Bank's reserves change based on Luis's withdrawal? Luis is taking money out of his demand deposits and he's removing it as cash. Well, the places where the Fed really can go, or excuse me, the place where a bank can go to give you cash, that's its reserves. So its reserves are going to decrease by 5,000. And I think probably it's nice to say that it will change by negative 5,000 or to say it would decrease by 5,000 because it's a little more specific. If you say it would just change by 5,000, then you're leaving open whether it's an increase or a decrease. But there's a decrease in reserves in this bank. Okay. Now, C, they ask us, how will the M1 measure the money supply change immediately upon this withdrawal, and then explain. And here, I think I'd like to go faster than I can write, so let me come up here and say M1 size will not change. Okay, why is that? And the reason why is because both demand deposits and currency in circulation are parts of M1. So the size of the M1 money supply did not change. The composition of the M1 money supply changed a little bit. All right, so there we are. That's our answer for C. Excuse me, B2, goodness. I'm really being sloppy with the structure of the question here. So we'll do it like this, and then come back up here and have that be little 2. Okay. Now, let's think about little 3 here. And this is probably where the rubber meets the road. I think 3 is most likely the toughest part of this question. Um, I'll tell you first that it's 500, and then we'll back through how did we get there, because now I need to go to the pen. And the way to get there, I think that's best, is to go up here and start altering or marking up the the balance sheet they gave us. Okay, so let's think first of all about reserves together. They asked us how much reserves changed. Well, how many did they have in reserve before? They had a total of 15,000. And we know that that 15,000 got decreased by 5. So how many do they have total in reserves now? Exactly an even 10,000. And then we'll start thinking about, well, okay, if reserves are at 10 and loans are at 85, then the total of their assets is at 95. That means the total of their liabilities also needs to be at 95. And in fact, that happened. The bank now would tell you Luis has $5,000 less in his checking account. So the total that all their customers have in their checking account is actually $5,000 less. So it's 95,000. How much does the bank have to hold as required reserves? We have to think about how many of those 10,000 are required before we can then come back and say, here's how many are excess. And if you remember, we calculated that reserve requirement. So some of the hints that they needed you to think about in order to get B3 right were already established in earlier parts of the question. The bank has to hold 10% of this 95,000. Well, that's 9,500. They have 10,000. So 9,500 of them are required, and 500 are excess. Let's see if we can get that in here somewhere, right? 9,500 are required, and 500 are excess. Maybe I could sneak that right in there like that so you can see that that's like the new value replacing the old one that was there typed in. There we go. Last part of the question. Assume the next day John withdraws from Metairie Bank an amount that exceeds the bank's excess reserves. You can very easily say, well, hey, they're in a bit of a pickle here. They only have $500 in reserve. What can they do? Well, fortunately, banks have the ability to switch back and forth between types of assets and liabilities that they hold. So some of the things that I might consider for answering this, and you really only need to say one of these to answer the question perfectly, but what could they do? Well, they could go get that money from the Fed and borrow it from the discount window and pay the discount rate as the interest rate on that loan. Or they could go to a neighborhood bank, a different bank, and say, we want to borrow from other banks in the federal funds market, and then pay the federal funds rate for that loan. And there's a third answer that you could give here. They said without calling in loans. Now, what does that mean? That means maybe I've borrowed money, a big amount of money for my house, and I'm paying it back over 20 years. The bank can't call me and say, hey, the whole amount's due tomorrow. That's not, I have protections against that in the form of the mortgage that I signed. However, what they might do, and this happens, maybe it's happened if your family has a mortgage, perhaps one bank that issued it then sold it to somebody else and say, hey, you owe them your mortgage payment now. They're going to pay us a certain amount today in exchange for this loan. And so they could sell loans. And those 3 answers are all supported by information in the grid here. If you wanted to go a little bit beyond that and think, are there additional things in real life that a bank can do? Well, of course, they could sell physical assets, but they didn't tell us that they had any, so it would be a little bit presumptuous of us to assume that they had them and then say they should sell them. Or, of course, frequently banks hold bonds, and so one of the things that you could do would be to sell bonds, but selling bonds and selling loans is pretty much kind of the same idea. Hopefully that helps you with understanding a bit about T accounts and how we can leverage all that information into a great performance on a short free response question. This will be like a 15-minute thing, and it's not uncommon for them to have one that's about the banking system, either in the form of T accounts or making you draw or mess with the money market graph. Thank you very much for watching TCon.